Hello everyone, welcome to today's DFT video. Today we'll be diving into the powerful tool that helps us understand how companies perform ratio analysis. So let us just jump in. First of all, what is a ratio analysis? A ratio analysis uses numbers from financial statements like the income statement or balance sheet to create meaningful relationships. These ratios allow us to understand a company's performance, efficiency, and financial health. So it's just looking at raw data and using them to make great insights. So why do we use ratios? We use ratios for comparability. They allow comparisons between companies of different sizes. Second is trend analysis. They track performance over time. And third is quick decisions. Ratios give managers and investors an instant overview of the financial health. So, what are the different types of ratios? Well, the first type is liquidity ratio. This measures if a company can meet its short-term obligations. So, a current ratio is the same as current assets divided by current liabilities. And a quick ratio is the same as current assets minus inventory, all divided by the current liabilities. So, let's look at an example of ABC Electronics. Their current assets is around $50,000 and their current liability is $25,000. The current ratio this means is 2 because it's $50,000 divided by $25,000. And this shows that ABC has twice the assets needed to cover its short-term liabilities. Now that's a good thing. Second is the profitability ratios. These reveal how efficiently a company generates profit. For example, net profit margin is the same as net income divided by revenue, and the return on assets is equal to net income divided by total assets. So let's look at ABC Electronics again, and let's say the net income is $10,000 and the revenue is $100,000. This means the net profit margin is $10,000 divided by $100,000, which is 10%. Now this means that ABC keeps 10 cents of every dollar in profit. And now we have the efficiency ratio. Efficiency ratio assesses how well a company utilizes resources, such as inventory turnover is the same as the cost of goods sold divided by average inventory. So let's imagine that the cost of goods sold by ABC Electronics is $30,000 and the average inventory is $5,000. Therefore, their inventory turnover is $30,000 divided by 5,000, which is 6. This means that ABC sells and replaces its inventory 6 times a year. And finally, we have leverage ratios. So leverage ratio. Debt to equity ratio is the total liabilities divided by shareholders' equity. So for ABC Electronics, if their total liabilities were $30,000 and their shareholders' equity was $40,000, the debt to equity ratio is $30,000 divided by $40,000, which is 0.75. This indicates a manageable debt level compared to equity. So how do you use ratios for performance evaluation? Once you've calculated all the ratios, you want to first of all compare them to the industry benchmarks. What's the typical for this industry? Second is analyze trends. Are the ratios improving or declining over time? Third is identify strengths and weaknesses, high liquidity or low efficiency. And fourth is make data-driven decisions. Should you invest or improve operations? So let's recap on ABC Electronics. Their current ratio is 2.0, which has excellent liquidity. Second is their net profit margin is 10%. That is decent profitability. And third is an inventory turnover of 6, which is a good inventory management, and their debt to equity ratio is 0.75. This means they're low reliant on debt. Over the 3 years, they've improved their profit margin from 7 to 10%, showing better cost control. That's great progress. So remember, ratios offer unique insights into performance. Comparing them to benchmarks and trends will give you a better idea, and use them to make smarter decisions. Now it's your turn. Pick a company, calculate its key financial ratios, and start analyzing. Thanks for watching. Don't forget to subscribe and like. And if you have any questions, please comment down below. Thank you.